Hey everybody, here is the Chapter 9 self-test. Again, I'll give my same disclaimer I give every time. I do not have an answer key for these tests, so I'm taking them just like you would be. And I do make mistakes sometimes. At the end, after I grade it, we'll go back and discuss any of my mistakes and explain why they were wrong and what the correct answer is. So it's always good to check at the end, even if you were just checking out one or two questions. So let's just jump into it. Chapter 9, land improvements are depreciable assets. That is true. Remember, a land improvement is things like sidewalks or parking lots, and they wear out over time, and so they only generate value over a specific amount of useful life, and we depreciate them across that useful life. 2, closing costs incurred to purchase a tract of land are included in the cost of the land, and the answer is true. With land, it's any cost that we have to spend to get that land purchased and ready to use, and closing costs is part of the purchase price. Number 3, Chorus and Company purchased equipment and incurred these costs. There's a cash price, sales tax, insurance during transit, annual maintenance costs. What amount should be recorded as the cost of the equipment? So same type of concept as question 2. The cash price, the sales taxes, the insurance during transit, and the annual maintenance costs, and we're supposed to figure out which ones are part of the cost of the equipment. And so in this case, it's everything except for the annual maintenance cost. Everything else is the cost of purchasing that asset and putting it into use. So the sales price, the sales tax, and any cost during transit. So that's going to be $24,000 plus $1,200 plus $200, which should be $25,400. Harrington Corporation recently leased a number of trucks from Andre Corporation. In inspecting the books of Harrington Corporation, you notice the trucks have not been recorded as assets on Harrington's balance sheet. What type of acquisition are the trucks for Harrington? So let's see, we're inspecting the books of Harrington. You notice the trucks have not been recorded as assets on Harrington's balance sheet. So we know that if we lease something and we record it as a transaction, or we record it as an asset on our books, that's what's called a capital lease. And so in this case, they lease them, but they're not carrying them on their books, so we're going to call that an operating lease. Which of the following is not a depreciable asset? Land improvements are, equipment is, buildings are, but land is not. Land does not depreciate. The idea is that its salvage value should be as much or more than its purchase price, so it will always maintain that value. It doesn't wear out over time. 6, which of the following costs will not be included in the cost of equipment? The annual insurance, the installation, the testing, the freight, and again, any annual cost is going to be an expense of that period, as opposed to all the other costs, which will be rolled into the price or capitalized into the price of the equipment. Number 7, Coronado Company purchased land for $80,000. The company also paid $12,000 in accrued taxes on the property, incurred $5,000 to remove an old building, and received $2,000 from the salvage of the old building. At what amount will the land be recorded in the accounting records? So all of these things are part of the capital cost. So if they had to pay accrued taxes when they purchased it, that was part of clearing up the purchase, then we're going to include that in the cost of the property. They incurred $5,000, but they received $2,000, so they received a net, or not received, it cost them a net of $3,000 to get rid of that old building that was on the property. So it's going to be the $80,000 plus the $12,000 plus the $3,000 in net cost to remove the building, or $95,000 total. Number 8, Massey Corporation purchased a piece of land for $50,000. Massey paid attorney's fees of $5,000 and broker's commissions of $4,000 in connection with the purchase. An old building on the land was torn down at a cost of $2,000 and proceeds from the scrap were $500. How much is the total cost of the land? Same as the previous problem. So it's the $50,000 that we paid plus the attorney's fees and the broker's commission, so that makes another $9,000. And then there was a cost of $2,000, but they made 500 back, so the overall cost of tearing down the building was 1,500. So it'll be 50,000 plus 5,000 plus 4,000 plus 1,500, or it should be 60,500 total. Which of the following costs should not be included in the cost of a building? Let's see, parking lot repaving, nope, that would be part of the land improvements, right? Closing costs, yes. Brokers' commissions, yes. And remodeling of office space prior to use, also included, so it's the parking lot repaving. 10, the book value and market value are synonymous terms as they relate to plant assets. And that answer is not true. Book value is your cost less any accumulated depreciation. Market value is the price that you could get for something if you went and sold it today at the market, or meaning to buyers that are buying today. So false, they are not synonymous. False, says Dwight. All right, which of the following is not a depreciable asset? Buildings are, driveways are, equipment are, but land is not. We've already established that. Number 12, which of the following is not a way to express the useful life of a depreciable asset? 5 years, yes, we can express it in years. 10,000 machine hours, we can express it that way. 30,000 units, or the cost of acquisition. So cost of acquisition is not a way to express the useful life. Seems silly, but that's the question they wanted to give us. 13, what is depreciation? A valuation approach, a cost allocation method, a cash accumulation approach, or an adjustment to market value over time. So if you remember, I said this, it says this in the book, I said this in my lecture, that what we're doing when we're depreciating an asset is we are allocating the cost of it over its useful life. We are saying this asset cost me $50,000, but it's going to last 50 years, so I'm going to allocate or spread the cost of it out over the whole life, or recognize $1,000 in that cost each year. So depreciation is a cost allocation method. That's what depreciation is. Number 14, when using the straight line depreciation method, which of the following is not a factor affecting the computation of depreciation? The useful life, that's a factor. The salvage value, that's a factor. The book value, that is not a factor, and cost is a factor. Book value is something we figure out through the computation, sort of. We will calculate what the book value will be when we know how much the depreciation is, because book value is the total cost minus any accumulated depreciation. 15, which depreciation method calculates the annual depreciation expense based on the book value at the beginning of each year? That would be the declining balance method. If you remember, in the straight line method, we always calculate based on the cost, multiply that by the depreciation rate. There is no method called the salvage method. The units of activity, we just figure out the cost per unit of activity, and then we use that, we multiply that by the amount of activity in any given year. In declining balance, though, we use the beginning book value of each year, multiply that by some rate, and that's how we calculate it. So D. 16, a purchase of equipment for $18,000 also involves a freight charge of $500, installation cost of $2,500. The estimated salvage value and useful life are 2,000 and 4 years respectively. Under the straight line method, how much is annual depreciation expense? So here, I'm going to bring up an Excel spreadsheet to use as scratch paper. All right, so again, we have the purchase price, $18,000, and freight was $500, and installation $2,500. Total cost is $21,000. If we take the total cost less the salvage value, salvage is $2,000. That gives us our depreciable amount, or depreciable cost, or you'll hear lots of different terms, the amount that we're going to depreciate, or depreciable basis. The total cost less salvage value, that's the amount we're going to depreciate, 19,000. Useful life was 4 years, so annual depreciation is just going to be the depreciable amount divided by the useful life, or $4,750 per year. 17, monthly depreciation expense of $600 is recorded on a truck that was purchased for $27,000 and has a $3,000 estimated salvage value. How much is the annual depreciation rate? Okay, so again, let me go back to my scratch paper here. So if I know that the truck, let's see, was purchased for $27,000 and a $3,000 estimated salvage value, 27,000 minus 3,000 is 24,000. So the depreciable amount is $24,000. We also know that we are depreciating $600 a month. So monthly depreciation is 600, which means our annual depreciation is going to equal 600 times 12, or $7,200. So now it's asking our annual depreciation rate. We can find that just by taking the annual depreciation and dividing that by the depreciable amount, 0.3 or 30%. Let's make sure there's not a, 30%. All right, on September 1st, 2014, West Buy purchased an asset for $9,000 with a $1,500 estimated salvage value and a 4-year useful life. How much is the 2014 depreciation using the straight line method? Okay, so, whoops, I guess I could have left that. The depreciable amount then is the $9,000 cost minus the $1,500 salvage value, so $7,500. And it has a 4-year useful life, so that'll give us our annual depreciation is the depreciable amount divided by the years in the useful life, or $1,875 a year. And then in this case, we purchased this on September 1st, 2014. It wants to know how much we did as an expense during 2014. So we're depreciating for September, October, November, and December, or 4 months. So if that is the annual depreciation, $1,875, then for 4 months, or what I would usually do is figure out a monthly depreciation. That's the easiest way for me, which will equal the annual depreciation divided by 12, and then multiply that by 4 months in this case. Or $625. Number 19, an asset purchased on January 1st for $48,000 has an estimated salvage value of $3,000. The current year's depreciation expense is $5,000, and the balance in the accumulated depreciation account after adjustment is $20,000. All right. If the company uses the straight line method, what is the asset's remaining useful life? All right. So again, we'll say our depreciable amount is the cost of $48,000 minus the salvage value of $3,000, or $45,000. Let's see. The current year's depreciation expense is $5,000, and the balance of the accumulated depreciation account after adjustment is $20,000. So it's telling us that the annual depreciation is $5,000. And it's telling us that we already have done $20,000 after adjustment. So that means 4 years of the asset's life have been depreciated away. So we know, first of all, we know if it has an annual depreciation of $5,000 and a depreciable amount of $45,000, then we know that the asset has a useful life of 9 years. If we've used up 4 years by having $20,000 in our accumulated depreciation account, that must mean that there are 5 years remaining in the asset's useful life. Number 20, the CUSO company purchased equipment January 1st, 2013 at a total invoice cost of $400,000. The equipment has an estimated salvage value of $10,000 and an estimated useful life of 5 years. What is the amount of accumulated depreciation at December 31st, 2014 if a straight line method depreciation is used? Okay. So again, figure out our depreciable amount. It is a $400,000 asset minus the salvage value of $10,000, so there'll be $390,000 in depreciable amount as an estimated useful life of 5 years. That will give us an annualized depreciation using straight line, or an annual depreciation, not annualized, of $78,000. Let's see. What is the amount of the accumulated depreciation at December 1st, 2004, or 31st, 2014? So if it was purchased January 1st, 2013, we've had 1 whole year to December and then a 2nd whole year to December of 2014. So 2 years of depreciation have been used. So if we know that 1 year's depreciation is $78,000, 2 years of depreciation would be $156,000. And that's the amount of accumulated depreciation at the end of December 2014. All right, which of the following will minimize depreciation expense in the first year of owning an asset? So this wants us to kind of think about the formula, so to speak. Again, we're talking about straight line. So the formula, if you think about it, is the cost minus the salvage value divided by useful life. So if that's the formula, and it wants us to minimize annual depreciation, then the ways to do that are to decrease the numerator, the cost minus sales, cost minus salvage, or increase the denominator, the useful life in years. So a long estimated life is going to, let's say we want to minimize depreciation. So the longer the estimated life, the less the depreciation will be. So that eliminates B and D. And then a high salvage value. High salvage value is going to decrease the numerator. So yes, so again, we're still on A or C. And then the declining balance depreciation, or the straight line depreciation. And if you remember, the declining balance depreciation has the highest depreciation expense in the early years, and then it becomes less and less toward the end, whereas straight line has the same amount of expense each year. So the one that's going to minimize depreciation expense is C, long estimated life, high salvage value, and straight line. Number 22, at the beginning of the year, Powers Company purchases a piece of machinery for $50,000. It has a salvage value of $5,000, an estimated useful life of 9 years, estimated units of output of 90,000 units. Actual units produced during the first year were 11,000. How much is the depreciation expense for the first year under the straight line method. So since it's the straight line method, all of this information about units of output and all that is just additional information we don't need. Really all we need is the depreciable amount, which is the cost, $50,000 minus the salvage value of $5,000, so $45,000. And then estimated useful life, 9 years. And so our annual straight line depreciation is going to be the depreciable amount divided by the useful life, or $5,000. And there it is. 23. A company purchased a dump truck for $25,000. In addition, freight charges were $500. An additional payment of $800 was made to paint the company's logo on the truck. The estimated salvage value and useful life are $3,800 and 5 years respectively. How much is annual depreciation under the straight line method? So again, we're starting to get sick of these, but they want to make sure we understand them. So $25,000 plus $500 plus $800. So the total cost of that truck is, what, $26,300. Salvage value is $3,800. So our depreciable amount is going to be the total cost, $25,000 plus $500 plus $800 minus the salvage value minus $3,800. Useful life is 5 years. Annual depreciation is the depreciable amount divided by the useful life, or $4,500 per year. Expenditures to maintain the operating efficiency and expected productive life of a unit are expensed as incurred. That is true. So any expenditures that are maintenance by their nature are just expense during the period in which they're claimed. Any expenses which prolong or extend the life beyond the expected life, or fundamentally change the use of the unit, say an expansion of a building or whatever, those will be capitalized, meaning they'll be turned into part of the cost of the asset. Number 25, a permanent decline in the market value of an asset is called an impairment. That's just a term you have to learn. 26, an asset purchased January 1st for $60,000 has an estimated salvage value of $3,000, current useful life of 8 years. How much is the total accumulated depreciation using the straight line method at the end of the second year of life? Okay, so again, we'll come back here. Depreciable amount, $60,000 minus the salvage value of $3,000 gives us $57,000 cost. 8-year useful life means an annual depreciation of $7,125. At the end of the second year, we'll have accumulated $14,250 in depreciation. On January 1st, 2012, Yamacha Company purchased some equipment for $15,000. The estimated salvage value and useful life are $3,000 and 4 years respectively. January 1st, 2014, the company determines the asset's remaining useful life is 3 years. What is the revised depreciation expense for 2014? All right, so this is a little more complicated than what we've been doing. So their purchase price is $15,000 less a salvage value of $3,000, so a depreciable amount of $12,000. And then they had a 4-year useful life. So there's an annual depreciation of $3,000. On January 1st, 2014, they readjust things. So in essence, so that'd be 2012 and 2013, 2 full years into the schedule. So at that point, they will have depreciated 2 years worth. So the book value of the asset at the time of the adjustment, so we're going to say book value at January 1st, 2014 is going to equal the cost of the asset, $15,000, minus the accumulated depreciation. So it's got $9,000 in book value left. At that point, they discover or they decide that there's 3 more years left in the useful life. I'm assuming that there's still $3,000 worth of salvage value. It doesn't tell me that. So the new depreciable amount is going to equal the book value as of that date minus the salvage value, and then the new useful life, which is 3 years. So the new annual depreciation will equal to 6,000 divided by 3, or $2,000 per year. Number 28, when there's a change in estimated depreciation, previous depreciation should be corrected. Nope, we leave that alone, anything we've done already. Current and future years depreciation should be revised. Yes, well, not current. That's a tricky question. Only future years depreciation should be revised. That's true. So we don't change anything except what's going forward. Or new plant assets should be acquired to replace the old. So I think that's what they're wanting there. 29, Able Towing Company purchased a tow truck for $60,000 on January 1st, 2012. It was originally depreciated on a straight line basis over 10 years with an estimated salvage value of $12,000. On December 31st, before adjusting entries had been made, the company decided to change the remaining estimated life to 4 more years as of January 1st, 2014. The salvage value was adjusted to $2,000. How much is the depreciation expense for 2014? All right, so here I think they're trying to trick us, although I could be wrong on how they want us to do this. So we're going to take a stab at it, and then when we correct it, we'll see if we made a mistake. So it sounds like there's no place to put this because I can't scroll. All right. So the original depreciable amount was $60,000 minus $12,000 in salvage value. The useful life at that time was 10 years, which gives us an annual depreciation of $4,800. This was purchased January 1st, 2012. So it would be all of 2012, all of 2013. And then it says on December 31st, 2014, before adjusting entries had been made, the company decided to change the remaining estimated life to 4 more years as of January 1st, 2014. And the salvage value was adjusted to $2,000. So really, since we haven't entered the adjustment for 2014, we've only had 2 years, 2012 and 2013 to this point. So 2 years worth of depreciation would be $9,600. So the book value at that point would be the cost, $60,000, minus the accumulated depreciation to that point. And then the new depreciable amount then would be the book value, $50,400, minus the new adjusted salvage value of $2,000, and the new useful life would be 4 more years. So if they'd only used 2, that would be 8, and now we're adding 4 more. So we're going to have a useful life of 12 from that point going forward. And the depreciation expense for 2014, so it's not there. So we've done something that it doesn't like. I think, so on December 31st, 2014, before adjusting entries had been made, the company decided to change the remaining useful life to 4 more years as of January 1st, 2014. So I think what they're trying to get us to see here is that you don't go back and change things that have already happened in the past. So since it was $4,800 per year before the adjustments, we're going to continue for this year that's already passed, and it's going to be 4,800 again for this year, and then we'll make the adjustment from 2015 going forward. I think that's what they're trying to get us to see, and we'll see when we grade the test. All right, which statement is true about additions to plant assets? They are revenue expenditures. They increase the repair expense account. They increase the purchases account, or they are capitalized. And remember, capitalized means added to the value or cost of the overall value of the asset or cost of the asset. And that is the true one. So let's grade it. It says we got 93% correct. So let's take a look at what we got wrong. And we're down to these two. When there is a change in estimated depreciation, and I put only future years depreciation should be revised, and they put current and future years depreciation should be revised, which was what led to my mistake on the next one. The Able Towing Company purchased a tow truck for $60,000. So apparently we should have included those changes. Let's see if we can figure out how they arrived at that number. So, Able Towing Company, the tow truck was for $60,000, 10 years depreciation, salvage value of $12,000. So that would give us a depreciable amount of $48,000, useful life of 10, annual depreciation of $4,800. On December 31st, 2014, before adjusting entries had been made, the company decided to change the remaining estimated life to 4 more years as of January 1st, 2014. So not 4 more years, I guess, over the original, but 4 more years. So at that point, December 31st, 2013, we depreciated $9,600. We have a new book value then of $50,000, or a book value of $50,400, and a new depreciable amount of the $50,400 minus the new salvage value of $2,000. I think where my mistake was is the useful life is supposed to be 4 years. I was thinking 4 years added to the 8 remaining, but they're saying no, the new useful life is just 4 years from that point, giving an answer of $12,100, which is the correct answer. All right, that is the Chapter 9 self-test. Hope it was useful to you. Have a great week.